Thank you, everyone, for joining this morning. It is a pleasure to be moderating a session with such an eminent panel of speakers. To set the context for today's discussion, we are all amply aware of the role and importance of NBFCs in the Indian economy. With over 9,600 registered NBFCs, the sector is about 25% of the asset size of the banking sector, with an unrelenting growth trajectory at a healthy pace of 14% over FY15, FY19. NBFCs primarily cater to unbanked masses in rural and semi-urban belts and lend to the informal sector and people without credit histories, thereby enabling the government and regulators to realize the mission of financial inclusion. Though banking system remains dominant, NBFCs have grown in importance by carving out a niche for themselves in focused customer segments and product categories, leveraging last mile connect and tech-enabled lending. In fact, NBFC growth outpaced GDP growth by FY20, an impact which was partially attributed to the overall the crisis happened in terms of non-performing loans. While the NBFC market was trying to crawl back from the entire crisis, it got hit by pandemic, which led the road to recovery to be extremely difficult. The situation became worse by slower credit growth and asset quality issues. Moratorium and government schemes came as a relief, but most considered it to delay the problem than resolve it. The focus shifted from disbursement to collection and consolidation. So, with that context, maybe I'll try and move to our questions. And so, historically, NBFCs has grown at a faster pace than banks. However, that growth has slowed recently. So I would like to go to Mr. Ramesh Iyer and have your point of view. Do you think it is pandemic induced, or are there any other factors which are making this?
Good morning, everyone, and thank you for this opportunity. Hope I am audible. The growth is a strategic plan of an NBFC, right? I mean, it's not that we just want to embark on this growth journey and just keep lending. We are all conscious of the fact how market is turning out, what are the challenges in the market. And you talked about the pandemic, but you look at it from the customer side. Are the customers ready to take so much of credit in these difficult times? At least the market that we serve, what we saw was customers are also cautious. I mean, they want to be absolutely sure and clear about why are they acquiring this asset. So one thing that we saw out there was, livelihood products are the ones that they are buying and not aspirational product. And to that extent, there will always be pressure. I think coupled with that, we saw non-availability of vehicles became one of the big issues. So even though we were willing to lend, there was demand for vehicle, but if the assets were not available, it led to some slowness in the disbursement for sure. Same is true when it comes to pre-owned vehicle. When the exchange programs don't happen, finance companies or banks are not repossessing and making supply available, even though there is so much demand for pre-owned vehicle, that demand is not being met. So I think you will have to look at it from 2 or 3 angles. One, what is the real thought process in an NBFC as to how much and how aggressively do they want to chase disbursement? 2 is to what extent has the pandemic caused this disbursement? And 3, of course, is the inventory that I talked of. But if I have to fundamentally talk about the sentiments of the market, I think they have held up after the second wave. And as it starts settling down, we saw bounce back of the economy, at least in the rural and semi-urban market. Clearly, the customer sentiments were very, very positive. And even all our collections started to improve much better than what we all went through in the first quarter. So one shouldn't just look at one particular point of time when a disbursement must have gone down. These are all business models. You should look at it from a little horizon of couple of quarters, couple of years. And I don't think we have all slowed down. You will see bounce back of even NBFC aggressively disbursing while they are managing all their challenges. So I would stop there and over to you. Thank you so much.
Thanks, Mr. Iyer, on your positive outlook. At least we clearly see from the industry perspective that yes, it's really not slowed down. There could be some demand supply gaps, and that's why people are seeing it kind of slowing down. But I think the entire discussion starts with a very positive note. I would like to request Mr. Mehernosh to emphasize his views on growth on NBFCs.
Thanks. Yeah, I think just to add to what Mr. Ramesh spoke, we lend to micro and small enterprises. And oftentimes they need this money more often than not because they're obviously capital starved vis-a-vis, let's say, medium corporates, right? So if you look at large corporates today, there is a tapering down on the debt that they have taken. However, if you look at recent data from the Bureau, we are seeing reasonably strong demand from the micro and small enterprises. Year on year, it's grown. The inquiries have grown by 25% on the commercial bureau. So I would say that, the way this whole pandemic has played out, there was a period when our micro and small enterprises didn't have demand for their products and services, and hence they obviously didn't need to go out and borrow more. But as the dust settles, what we are also seeing is good businesses, viable businesses, especially in the micro segment, who need that additional help are coming back up and wanting that additional funding as growth capital. So I do see this playing out positively. All data that is there is showing improvement in sentiment. We had a dip in sentiment at the time of the Omicron wave, but if you look at recent data, if you look at even the mobility index, etc., all of these are clearly showing much better signs currently. And I think the next 1 year is going to be an important transition year, both for the NBFCs and for the micro and small enterprises who sort of support the country's economy. Thank you.
Thanks, Mehernosh. Considering the impact of COVID seems to be highest in the areas of MSME, since you said that it's again kind of moving up. When you look at the MSME microfinance lab, Mr. Bindra, I would like to have your take on the future of these segments for someone like yourself who has recently acquired a small finance bank license, which primarily focuses on these customer segment groups, which are basically MSME microfinance kind of.
Thanks, Nitin. MSMEs and MFIs are actually the biggest opportunity for the financial services industry. Whichever way you look at it, as percentage of GDP, just as numbers, new to credit potential, etc., etc. But they have traditionally been either unserved or underserved. All official data points in abundance evidence to that. And so they have been denied credit denied access to credit, or have received very limited credit. And their entire resource base is limited to their personal resources, their families and friends. And that curtails their ability to scale. Also, the ones who resort to local money lenders, which is a big temptation for many of them, just because of the high rates, etc., just end up being perennially in debt. So I think the most important thing is we get adequate credit at competitive rates to these segments. And beyond that, we have to develop in the formal sector an understanding for these people. They have temporary dislocations. Anything that is unplanned, they have no surplus or contingency. Unexpected events, unplanned events, phases in their business cycle, they don't. But let's not forget, they know their business. Many of them are doing this for generations, this family businesses that they have been doing. And they take their debt obligations, I would say, even if I was being modest, at least as seriously, if not more seriously than the corporates. And the urban society that we live in. So I think, we just need to demonstrate that we get credit access to them at good rates and have that understanding that when there are temporary dislocations in their business or situations in personal life, that we are able to back them up and make it happen. But I do believe that they remain the best opportunity for all of us on this panel, at least.
Yeah, thank you, Mr. Bindra. I think you made a very pertinent point that when there is a small blip in their business, how do we really handle that? Then getting real panicky and looking at those NPLs. And I think that's the key to a sustained growth in this segment. In fact, adequate liquidity, as you mentioned, is a key area of concern for NBFCs in order to control cost of funding and sustain profitability. This is a problem faced by both diversified NBFCs as well as NBFCs working in niche segments. For example, smaller companies still struggle to raise funds at competitive rates compared to other who have a strong parentage either by a bank or a corporate house. Mr. Jairam, I would like to turn to you and to seek your opinion as to what are some of the key concerns you see going forward in terms of interest rate environment, and what kind of NBFCs will be able to keep their liquidity intact, both in a diversified space as well as in a product or niche space like yours?
Yeah, thank you, Nitin, for the question. Thanks, ET, for hosting this panel. I want to first, if you'll allow me, Nitin, I want to just go back a little bit to what was being said just now. Jaspal was speaking about the MSME space and blips that might come up in MSMEs in their businesses. One other interesting aspect of that I have realized over this last 2-year period is the ability of MSMEs to entirely reinvent themselves and reinvent their businesses when something bad happens. Like you and me, if God forbid we lose our jobs tomorrow, right? I will look for another job in banking. You will probably look for another job in consulting, right? But rarely are we going to think of entirely reinventing ourselves and doing something completely new. But with NBFCs, what I have seen is that they are super resilient and they are quite willing to reinvent themselves. So, anecdotally, one interesting anecdote which I think brings this out for me very really is this MSME borrower that we saw who has been in the travel agency business for decades, right? And he had this small travel agency shop and outlet. And of course, he got decimated in the first year of COVID. His business totally went bust. And he made a choice at that point of time to get out of the travel business and actually, shut down that shop and instead opened a pharmacy in that same outlet, right? And that pharmacy started doing really well. And now that he has seen it for a year, he came to us for a loan saying, "Hey, I want to open another pharmacy," right? And to Jaspal's point, a lot of these types of customers are going to come to NBFCs rather than to banks, because a bank is going to look at such a customer and say, "Hey, you don't have 3 years of experience in this business." Right, so he's not going to get that loan from a bank, right? But NBFCs will consider it, and he will end up. So this idea of resilience of the NBFC customer base is an important one to keep in mind as you think about the NBFC story, right? And just like the customer base of NBFCs are resilient, NBFCs themselves have been very resilient as well. You spoke about growth rate in the past. If you looked at NBFCs as a share of total credit 3 years ago, NBFCs were much higher than what they are today, right? They were about 30 to 35% of total credit was the NBFCs. Today, that's down to 25%. But the historical average has been around 25%. The 35 was an aberration, not the 25, right? So it had gone up a lot based on some NBFCs going kind of really helter-skelter growth. But some of those actually went out of business in many ways. And hence we are back down to that 25%, that regression to the mean has happened. And that gets me to your question of liquidity, right? What happened in 2019, late 2019 with ILFS and liquidity just getting sucked out from a lot of people in the NBFC sector showed people once again that having a business model which is retail on the asset side and wholesale on the liability side is always going to have issues of confidence in moments when there is a crisis of confidence in the market. And what we have seen in this last 2 years is that having the pedigree and the track record and the brand name that the markets will continue to support you, both debt markets as well as equity markets will continue to support you, is a key requisite. So otherwise, you can be in an environment like today where there is 6 lakh crores of surplus liquidity in the market and still not get liquidity as a lender, as many fintech NBFCs are finding out just now, right? You don't get lending to you, even though there is so much surplus liquidity in the market. So having the right track record and building that trust in the wholesale lenders market is a key requisite in a country like India where wholesale debt markets are still quite shallow.
Correct. Thank you. In fact, as you rightly said, that again, that the resilience and the reinventing themselves is a very big thing, which is a point you rightly made. But again, when you go to the formalized system, people start looking at business, how old is that business and all of that? How do we really move that entire needle from business to the entrepreneur in this microfinance and this MSME space is the key, I think. And that's very important for everybody in this NBFC world to learn about. In fact, I would like to request Mr. Gupta to provide your vision with respect to liquidity and funding challenges in the transport finance space. As with COVID, what we have seen, even the commercial vehicle and logistics industry has also faced similar issues. Like earlier mentioned, that there's also shortage in terms of vehicle and all of that.
So good morning, and thank you for having me in this Augur gathering. As far as liquidity is concerned, the last 2 to 3 years, NBFCs have been able to, tap into the alternative products and instruments that Reserve Bank of India from time to time have been launching. It's not about, the large NBFCs. Indeed, the regulations have changed for ALM. There are things like HQLA. There are things like liquidity coverage ratios. And obviously, the credit rating firms, they come up from time to time with amount of cash balances that need to be retained in the on the balance sheets. Those things are pretty much there. That helps in better ALM and helps in protecting the systemic risk. But at the same time, what we saw in the last 2 years, the kind of money that came through the TLTRO scheme that Reserve Bank of India launched, where banks could participate in the bond market and buy into NBFC's instruments. The government guaranteed, the partially guaranteed bonds. Along with that, the strong impetus that we saw in the direct assignment market, I think helped the NBFCs to raise money. The smaller NBFCs could have also raised money through the SIDBI refinancing program. And to my mind, I think that has helped. Added to that, I think, NBFCs have always operated in territories which are uncontested, where banks have not have their sourcing channels out there, whether it's demographics or whether it's geographic. At the same time, NBFCs are very innovative. They always make these early entries and have tremendous amount of local knowledge. This helps banks to follow the NBFCs after a period of time. And I think this is the time that banks are following the NBFCs, and partnerships need to be built. And to my mind, the asset-light offerings that are available either through co-sourcing or co-lending or direct assignments, I think all the small NBFCs, the medium-sized NBFCs, they should partner with the banks and raise the money. 20% of the asset can be in the books of the NBFCs, and 80% of the asset or the risk can transfer to the banks. This will help in having an AUM approach and not an on-book approach. The NIMs will expand. And to my mind, that kind of liquidity is highly encourageable for the NBFC segment. So focus on the uncontested market, stay innovative, ensure that we are able to get a lot of bank following into it, and get the partnership with the banks so people can take advantage of co-sourcing, co-lending, and direct assignment, along with the SIDBI programs and the government guaranteed programs. To my mind, it's a great time for NBFCs to tap into that segment and tap into that liquidity. Borrowing costs will go up. It will have range bound. It will be range bound. We do not think that it's going to be a perennial increase in borrowing costs. And it's a good time to ensure that all these factors are taken into consideration. Thanks.
Thank you, Mr. Samrat. Moving to another piece, the trend what we are noticing is that all fintechs want to become NBFCs, NBFCs want to become a bank, and banks want to become a neobank. Mr. Tata, may I request you to share your outlook of NBFCs becoming neobanks, and how would that be different from digital lending models that we see in the market today?
Thanks. I'll probably just take a minute additional to your last question and highlight the fact that I think being asset light is one of the learnings that most NBFCs, at least outside of the parentage NBFCs, most of the other NBFCs have really realized. And as Mr. Gupta spoke about, right, I think getting into a co-lending model, just look at the securitization deals that have happened pre-ILFS and post-ILFS, right? And you'll see a stark difference of most banks, NBFCs, HFCs, I would say, and NBFCs, really looking to monetize that portfolio and look at alternate ways of bringing in more liquidity or enhancing the liability partnerships. I think one thing is for sure, you just today cannot singularly rely on bank funding, and you need to swim your own way and figure out various ways to raise and augment your liability partnership. So I think that market is still out there for disruption, and I think it's interesting to see some of these new things shaping up. Right now, coming to your question in terms of how the fintechs and NBFCs. I think one of the fundamental differences that you see, it's an evolution curve, and fintechs come in from a perspective where they look at the end customer and they are mobile first, want to do everything digitally. And I think we've seen a lot of new businesses come in on the B2C side, Nitin. However, if I were to sort of look at the landscape today across NBFCs or fintechs, there are hardly any which can truly call themselves fintechs who are serving the B2B segment, lending to, let's say, MSMEs in a very, very true way that we are talking. I think the approach is, and the direction is towards that, but I would say it's more phygital right now, where organizations, there are certain organizations which have leapfrogged and today have digital processes, have a lot better engagement with their end customers, hyper-personalization, etc. And there are organizations and NBFCs which are slowly moving towards that as well, depending on your customer segment, right? So if you have an affordable customer, you may necessarily not need to get into the digital mode immediately. But if you have a savvy customer and your segment is a little different, who has a digital footprint, you could move towards that over a period of time. I think sachet loans, the ability to price very high, the centralization of operations, underwriting, etc., characterize a fintech. Whereas NBFCs, if you see, are a slightly more broad-based. You do have people on the ground. While you may call them brick-and-mortar offices, at least you have hub-and-spoke models. You have good collections infrastructure, because that's one of the prerequisites, right? I think in lending, one of the things that the fintechs are still grappling with is how do you take care of the collections and recoveries. I think they are very good in terms of data science. They're very good in terms of cracking the code on acquisition. But as we get along, as we all know, just giving a loan is not the end of the story. The story starts after that. So I think that's one piece which is still getting worked upon. And I think, like most of the panel members said, it's going to be not fintech or NBFC. It's going to be NBFCs and fintechs and banks. It's a partnership role where you leverage the capabilities and competencies of the partner and try and improve your end service to the customer. That's the way I look at the ecosystem going ahead. Thank you.
Oh, well said, well said. Thank you very much for your views on this. As we all know, that none of the opportunities come without challenges. One of the challenges or tasks in front of NBFCs is to ensure good asset quality and sustained profitability. Mr. Iyer, may I request you to put some light on how big is the asset quality issue? Do you think it is behind us, considering the cleanup that has recently happened, or you still see this as a challenge?
I think first and foremost, the regulator is not going to allow you to get a feeling that it's all over. Right, the November 12th circular has made all of us rethink on what's the new number going to look like. Even though there is some extension given up to September, nothing on the ground changes for the customer just because the rule is new. The customer cash flows don't change with the rule. So therefore, there will be some continuing pressure in terms of customers' ability to earn and pay on or before the due date. My personal view on that is that these are such customers who knows that he has to make the payment, and in his own mind, he has to make the payment in a month. The date is more an indicative date that we have given to him, right? So therefore, it is going to be a pressure on the customer, because all of us will chase him, repossess vehicles aggressively. Some lending will go low because we may choose not to lend to certain segment of customer if this is the rule we have to follow. So all that is going to happen, and I would imagine that new things will keep coming as we think the earlier one is set it. But I think overall, the way one has to look at the credit is not the provisions that you really make, and therefore everything looks to be very large. You have to look at eventually what's the credit loss. Ultimately, why do you go into secured lending? You have an underlying collateral, and the customer, if he's unable to pay, we have an ability to take back the collateral and transact on it. And historically, we have seen, and that's what NDS is guiding us as well as to how do you want to account for all of that, right? Now, therefore, if temporarily the provisions have gone up because the gross NPAs go up because of the customer earnings going down, I would think we have to differentiate between model problems and circumstantial problem caused by events. And we will have to look at it on that basis. We shouldn't look at because of the pandemic what happened and then start feeling, oh, is the NPA going to remain this high? Unless all of us collectively believe that certain segment of customer is going to vanish because of the pandemic problem, or certain application of product is going to collapse because of such pandemic issue, then it's a question of remodeling yourself. But otherwise, NBFCs have run these businesses for last 15, 20, 30 years. And there has not been, at least my experience, there has not been a single year in my 30 years where we have not had a problem, at least in one state or the other. Yes, this time around, it has collectively come across the country. So the problem looks to be larger and everyone thinks, oh, is this a bigger problem? But every state goes through this every year due to some reason or the other. And NBFCs have the ability to partner the customer in these difficult times, pull them out through some solution, and then get back on the journey of growth again. So I wouldn't be overly worried if we were to believe that we have had quality issues in the system for some time. The fundamental question is, do we see light of ability to come out of it? Do you see your customers able to come out of that? And therefore, the models are still strong and adequate. And are we all adequately capitalized to handle these situations? And that's the belief that we throw out in the market to say, why do we capitalize businesses if we don't have belief in that business model? Right? So therefore, if all of us are sufficiently and adequately capitalized, we are investing in our people to be future ready. All of us are investing in the technology to be able to serve the customer. I think those are the indicators one must look at to say the problem seems to be out and over. If the problem was still large, I don't think all of us are going to invest into these areas, imagining that, at some stage things will become normal. So my take is things are settling down. It is getting to normal. We will all have to learn to come out of this over a period of time. We should be transparent in expressing the problem that we are all facing. But I don't think the models are cracking. These are transactions or temporary phases of pressure. And I think we've learned it the hard way, and I'm sure all the NBFCs will come out of it.
Thanks, Mr. Iyer. Well said. You rightly said that this problem has been always there, either in pockets or segments or in certain areas or geographies. We really need to overcome this and not make it as a large.
Just I'll make one additional point. We all consciously got into this segment of customer. We know they are vulnerable when they, come into these kind of disruptions. And therefore, it's not that we were all caught unaware.
Yes.
As a business leaders, we were all very conscious as we got into these segments, right? And therefore, this vulnerability is a known business model reality.
As we know, NBFCs encompass a wide variety of subsegments from microfinance to housing finance. Regarding automobile financing, the sector has seen some pickup due to electric vehicles and MUV demand, and some drag due to chip shortages. I would like to take it to you, Mr. Samrat. What's your outlook on the sector, and how can auto-focused NBFCs capitalize on these trends?
Sorry, I just lost you. There was some problem in the network. Can you kindly repeat the question? Shall be grateful.
Sure. So I was saying that regarding automobile financing, the sector has seen some pickup due to EV and MUV demand, but at the same time there was some drag due to chip shortages. I would like to ask you that what is your outlook on auto-focused NBFCs? How can you capitalize on these newer trends in the market?
Well, to my mind, I think chip shortage, EV definitely is going to happen over the next 3 to 5 years. But ICE engines are not going to go away, especially in the commercial vehicle segment. Chip shortages are temporary. They are all going to get sorted out in the next 2 quarters. One should not be taking a short-term view as far as chip shortages are concerned. Yes, there will be primary channel funding and all that will trail initially, but over a period of time, we are quite confident the big OEMs will be able to correct that. As far as auto OEMs are concerned, my personal view is this, that there are 3 segments, the traditional financing segments. One is the vehicle financing, second is the housing financing, and third is the gold financing. These 3, will see growth in the next 12 to 18 months. And to my mind, I think a growth of about 10 to 15% as far as AUMs are concerned, or AUMs, I think AUMs is the right way to put it. That kind of growth will be there. NBFCs should continue to do 4-5 things, which auto OEMs always take resort to from the auto financiers. The 5 areas would be, I think, auto financing AMs, vehicle financing AMs have a very strong customer relationship. The kind of sourcing capabilities that has been built over years, the kind of local knowledge that is available with the NBFCs, and the amount of responsiveness the NBFCs come to solve, the issues of the transport operator or even the MSME or the FTU players. The kind of collection infrastructure we have built over the last 10 or 15 years, and the last mile service delivery which we can offer. These are the 5-6 areas I think NBFCs should continue to invest in the core. And automotive growth has started. It's I would put it this way, that you can cut down all the flowers, but you cannot keep spring from coming. The spring has arrived. At this point of time, the big bull run of commercial vehicle market has started. There are little bit of blips here and there. The pandemic is behind us. Omicron is behind us. Ukraine war is not affecting us in a very big way. To my mind, I think the spring has arrived for the auto financing companies. We should partner with banks. We should partner with fintech companies. This time it will be different, because the collaborative Indian digital stack is pretty much up there. The KYC layer, the biometric layer is fully digitized. The unified payment layer is fully digitized. The account aggregator layer, where the customer health is constantly monitored, that RBI has done a great job. Account aggregators are there. And the open credit network, as we know, is going to create a democratization of lending in this country. This is the best time to be an NBFC, focusing on the core, all those 4-5 items which I told you, taking advantage of this entire digital stack that is available, which the fintechs and the banks are partnering us with, and try to grow at the rate of about 10 to 15% in the next 2 to 3 years. That would be my take on the auto financing NBFCs.
Thanks, Mr. Gupta. In fact, COVID-19 pandemic has also inculcated work from home culture. In fact, we are all doing this event, which we used to do in a very large setup. We are all doing it in a virtual mode today. And this entire reverse migration to hometown, working from home, and for the entire working culture which has gone back to home. I would like to see your views, Jairam. Since you are a niche housing-focused finance company, do you see some trend in terms of lowering housing demand if people go back to their hometowns, and this entire reverse migration? How will it impact the housing finance companies?
Yeah, so think about it the other way. Actually, what we are seeing in the market is that in the big towns, we are seeing ticket sizes move upwards as people are looking for slightly larger houses than what they have sought in the past, because there is need for someone, at least occasionally, to be working from home. So there is just the space need is larger. So there is the product that is moving the most is all kind of a little bit larger than what used to be the case in the past. And on the other hand, in the smaller towns, we are seeing a big revival in demand. Right, there is just a lot of sort of talent, young people who are living now in smaller towns where they weren't staying before. And as they set up their households, they are looking for places to stay. So demand is in the smaller towns for not just housing, by the way, all sorts of other demand has really gone up. You go to any small town in India today, and you will find that if Zomato or Swiggy are not there, there'll be some local equivalent. right? Some local guy has set up essentially a restaurant delivery service, right? And it's just a call away, and you just call somebody and say XYZ restaurant ABC is my order, and he will go pick it up and deliver to you, right? This is a new business that has just emerged in these small towns which didn't exist before. So economic activity in smaller towns has gotten a lot more enhanced and more broad based as more economically viable activity can be done from those small towns, which just couldn't be done in the past, right? So overall, from a demand standpoint, it has really enhanced demand across the board, and it has actually democratized things where the erstwhile sort of small towns, tier 3, 4, and 5 towns, are suddenly seeing an influx of income which they never had before, and that goes into capital expenditure like buying a house, etc., or buying a car, but also into consumption expenditure, which results in lots of other products, loan demand. So it has all sort of it has all gone into, if you see the industry level numbers, right, and if you see where we are right now in terms of credit demand, you can see very clearly that credit demand as we stand today has gone, of course, higher than what it was pre-pandemic, right? In terms of number of inquiries that are happening on the bureau, we are already now at about 15% higher than where we were in Jan, Feb, March 2020. So that tells you, in a nutshell, what's happening in the industry as a whole. That demand is up, not down, from where it was pre-pandemic.
Thanks, Jairam. Now, I'll turn to Mr. Bindra. The RBI has recently released a circular standardizing asset classification norms across lenders. One of the key implications of the circular for NBFCs is the upgradation of accounts to the standard only after a full payment has been made, which was earlier upgraded only on interest payments. What do you think? How it will impact NBFCs or the lenders going forward? And could we expect any pressure in terms of profitability?
So I think, Nitin, one trend is clear. The regulator is wanting to bring a lot more, regulation into the system. And I think some of it is just a progressive evolution that you see in all, we've seen it in all developed markets. And some of it is as a result of the series of accidents we've had, ILFS, DHFL, Reliance Capital, Shrey, etc. So it's a reaction to that. But in all senses, we have to consider this as a positive step. Yes, it does put a burden. It puts a burden on the NBFCs, and there is a need to adapt, and how the transition period is handled by the regulator, and the transition learning and experiences accommodated by the regulator will be the key, because we just can't switch things on and off. As Mr. Iyer said, overnight, and these things take time from a customer behavior point as well, and that has to be kept in mind. But I think as leaders of businesses, we had to see this coming, and yes, it will have a temporary impact on profitability if you say you're going to do no different from before. But clearly, you have to do things differently as well, which anyway we are having to do. In the past, NBFCs were used to a leverage of 6, 8, 10 times their capital. That has already disappeared. I think many speakers have already said that the arbitrage model of wholesale borrowing and retail lending is kind of being put to test. So I think, this will be one more step in that evolution. But in the long run, a compliant culture, one that is based on good practices of conservatism and providing confidence to the customer, has to be good for the NBFC, however much it's a challenge to adapt to.
Okay. Can I have your views as well, Mr. Jairam, on this? How the circular will impact?
See, Nitin, if you go to the basics of what the circular says, hey, kind of tag somebody as NPA on a daily basis, not at the end of the quarter. And once tagged, for you to untag, you have to get all the payments rather than just getting one payment and pushing them back a bucket, right? So fundamentally, what this does is it basically recognizes something as NPA a little bit sooner than what you were recognizing before, right? Now, what it does not do is take customers who are fundamentally healthy and actually ask you to tag them as NPA, right? These customers are in distress, right? Because they were 60 days past due, they were probably crossing 90 days as well, and you were able to get a little bit of money and sort of pull them back in. So these, by no means can we make the argument that these were fundamentally sound customers who are now being tagged as NPA. They were weak customers, but the old regime allowed you to continue to keep them in a non-NPA bucket, and now you have to put them in the NPA bucket. But if you play the story out into the future, I don't think anything economically changes. Fundamentally, if these were weak customers who are eventually going to go into the NPA pool maybe a few months later, and then you are going to take a little bit of a credit loss, then now you are sort of pulling things forward a little bit. So the economic impact that you spoke about, or the P&L impact of moving to the full November 12th circular in all its glory, there is going to be an impact for sure, but it's going to be a short-term and one-time impact. Beyond that, it's not as if your credit costs are going to be permanently elevated. It's quite possible that your GNPA ratios find a new normal, right? And that's what happened in banks, right? Banks went through this transition 2 years ago. So with all banks, you saw this when they migrated. You saw that in the quarter or 2 quarters where they migrated, you saw incremental credit costs come in. And then you saw GNPAs go up and then settle at a slightly higher normal than where they were before. But fundamentally, ongoing credit cost metrics did not change, right? Which is exactly as it should be. That's what economic theory would suggest, that credit costs on an ongoing basis will not change. Your stock metric of GNPA ratio might get to a slightly higher normal, but that doesn't matter. From a P&L standpoint, apart from that one-time initial impact of having to do pull forward provisioning for the group that in the quarter of transition, beyond that, the ongoing P&L impacts are minimal to none. That's what the experience of all banks have been as they made the transition. I was kind of the CFO of a bank, when we went through this transition 3-4 years ago, and this is exactly what we experienced there. And I have no doubt that that's exactly what the NBFCs will experience as well. So we are not at all perturbed by the move to this, and the market, the investors, etc., are also smart enough to understand, because they have seen the banking sector go through this. So everybody is smart enough to understand that any impacts on P&L are transitory, and the long-term impacts are going to be nothing.
Can I just make a point, please?
Sure.
Yeah. Slightly different to look at. We are all on India's accounting. And therefore, you have to put them in the bucket that the customer belongs to. If he makes one payment or two payments, he moves into a stage 1 or stage 2 on that basis. Now, there is a requirement to, under the Iyer Act, to call them an NPA and then make this additional provision. So, fundamentally, that's a real difference. On the book will reflect something versus the regulatory need is something else. And then you create this additional provision to meet that regulatory requirement. I think that's the challenge that one needs to address, and that's the discussion with the regulator as well, to say that if you're in India's accounting, then it should be left to be on that basis, and why do we need this additionally to be done, unless you want to see whether the companies are adequately capitalized to absorb these kind of numbers, if at all. Second is, my view would be, in a auto business, auto retail business, especially single truck operator, first time borrower, first time buyer of vehicle, 30 days, 60 days, etc. is so very common for these customers. So they are not really delinquent by that. Many of them are with the vehicle traveling to different locations. By the time they come back to base location to make payments, there are challenges. So I think there is certain segment of customers who have to be looked at very differently. These are the discussions that with the regulator is on an ongoing basis, and some solutions would be found. But, today also such NPAs have to be reported to the bureau. Now, how will these customers start getting more loans for their growth, etc., if required once they are tagged NPA? That's going to be another set of challenge. And companies will be under pressure, I'm sure, reasonably. Some repossessions will go up in order to come out of this situation, because there are different types of NBFC operating at different levels. My whole fear is, will it also create some kind of a systemic pressure, and someone starts defaulting somewhere, and then that starts to again come and hit the NBFC as a sector. So I think we have to look at the way NBFCs are as compared to banks. See, banks are at the end of the day overall guided by certain approaches, and then they're all following that. NBFCs as regional levels are so different from the large NBFCs. Different levels of NBFCs. The banks don't lend to smaller ones if their NPA was to suddenly go up, and then that will start building pressure on them for their growth. So I think one has to be more holistically look at the challenges that it can bring instead of just that one line item of will NPA provisions go up and therefore will it look differently? Maybe it will look differently, and as was explained, everyone will know why and what, and they will get adjusted. But the cascading effect of what all will it impact if such accounting treatments were to be given is also something to be looked at. Thank you.
Sure. Mehernosh, I'll turn to you. I think you had some views on this.
Yeah, I just wanted to highlight, in addition to what Mr. Iyer was saying, frankly, I think you're running against the organized, I would say, the country mandate. On one hand, we want to do financial inclusion. And this is the segment which traditionally banks will not really look at. I mean, NBFCs, HFCs are the last mile connector to these segment. And when you get in and you have some clients who are, delaying it by a few days over 90 and they're pulling it back because that's the way their cash flows work. By tagging them as GNP or NPA, you're fundamentally stopping them from getting any incremental credit from other financial institutions, right? So I think it's against the whole mandate of financial inclusion that the government of India, frankly, is looking to drive. The other thing is, on one hand, we are talking about coming and doing harmonization across banks and NBFCs. But today, as an NBFC, we can't get into SARFAESI. Let's say if a secured exposure or a movable asset exposure is 8 lakhs, 10 lakhs, 7 lakhs, because I think less than 20 lakhs, you still don't have the ability to go and knock the doors on SARFAESI. So I think if we are looking at harmonization, I think the regulator also has to give the tools to the NBFCs to look at it. But frankly, I would agree with Mr. Iyer that I think they have to look at it a little differently. The NBFCs over decades have flourished because of light touch, I'd say, review and governance. And of course, for the top 10, top 20 names, you must do everything that is right and look at it very bank-like. But for the other subsegment, because 40% of the AUM is by the top 10 NBFCs in the country, right? And then you have a very long tail of others who are really looking at it. Can for the others, you have a different yardstick so that you continue to give the opportunity to these financial institutions to offer last mile funding to so many people who need this. So I think that's the take that I would give.
Yeah. Well, thanks for your views. In fact, I'll again turn back to you. See, the retail lending books and unsecured personal loans seems to be the current flavor of for lenders. I would like to seek your outlook on competition in this space, given that banks, fintechs, NBFCs, all are fighting for a piece of the pie. How do you go about evaluating a new to credit retail customer?
Firstly, I think there's enough fish in the pond for everybody to come in, right? So if you ask me, I really don't see that as a challenge. And the more you have competition coming in, I think it also sharpens your ability to go out and compete and do better. So I welcome competition, and I would say that I think that is a good thing for the sector. New to credit is getting viewed very differently. And if you see the credit bureau matrix, clearly post the pandemic, we are now seeing again close to 25 to 30% of all new trade lines coming in for new to credit, right? And pre-pandemic, probably it was closer towards 20-22%. So very clearly, we are now starting to see banks and NBFCs wanting to relook at lending to the new to credit segment. And as Mr. Gupta also spoke about, you see the ecosystem is also developed with eKYC, video KYC, the ability to go out and do a lot more digital processes. Your cost of acquisition for those sachet loans have also come down. And therefore, a lot of banks and NBFCs, I mean, today, an HFC could very comfortably, to a salaried customer, offer a housing loan, end to end digitally without even meeting the customer, because end use is monitored. You're cutting the check to the builder or to the party, and you've gone through the process by looking at the salary slips, bank statement, maybe pulling it out from source through APIs, and being able to verify the whole transaction through and through. So the way I look at this is that the new to credit segment will continue to evolve. There will be a set of innovators. There will be a set of fintechs, if you may call so, or a set of financial providers who will get this segment in. This will get credit tested over the next 6 to 12 months, and then you'll have a next set of lender who will be happy to provide slightly more than the sachet loan that they've taken. And that's been the evolution. If you see, people start with gold loans, two-wheeler loans, then they get on to the next product and the next product. And at some point of time, you build yourself something called as a thick file, which effectively then makes you a bankable customer, and you end up. So, in a way, NBFCs are doing a good job of getting these customers to that level where after a few years, as natural evolution, if they've done well personally or professionally, depending on whether you're salaried or self-employed, you do get funding at prime rates.
Thanks, Mr. Tata. But now let me go to a very hot topic for last 2 years, and that's the co-origination of loan schemes by banks and NBFCs. The way it was envisaged to benefit the end borrower by providing very affordable rates. Although the conceptualization is very well in line with the intention of the regulator, there have been some critical operational challenges wherein banks typically tend to take the stricter version of the directions, thereby limiting the scope of NBFCs to take charge in the arrangement. I would like to have views of Mr. Iyer. What do you think? Why we are not seeing so much of success in this entire co-origination?
I think it's from both sides, right? I mean, you said banks take a stricter view. Maybe NBFCs first want to build their balance sheet before they can do the co-lending part of it. If there is a segment of customer whom we can directly lend to, we have sufficient capital and liquidity, then obviously the question will be, should we co-lend? And therefore, all of us will look for that segment of customer who is very price sensitive, and therefore co-lending with somebody can handle that price requirement. Or there could be another segment of customer where both the lenders look at it as a different type of risk, and therefore we need to figure out how we do. But I think more than all of this, I also see the administrative reasons like the tech readiness, compatibility between the two systems. I think all of this also takes some time. And three is, obviously banks and NBFCs are driving a very different process to lending. And therefore there has to be this better understanding on what will be the right process by which, if you were to lend, will be well understood by both the sides. So I think we should agree to that it will take some time, but I think it's better to set it up correctly rather than setting it up with some volumes taken and then it's actually set up to fail. So I think unlike many programs of the past where we have embarked on the journey very fast but didn't scale up. But I think in this particular event, I would think that while it takes a little longer than everyone wanted it to be, but I think it's being set up to succeed, and this would stay as a long-term model and it will do well is my view.
Thanks. Yeah, what we've seen in the market is banks are looking at this entire problem in a very different way. What they are looking at is that, can I get tie-up with, in terms of co-lending, co-origination with larger NBFCs, which are top 10, top 5 in India. And when I hear them out in top 10, top 5, we have enough funding available. Why don't we build our own book first? So how do we really come out of this challenge and make this scheme successful? Mr. Bindra, any views from your side? And how can smaller NBFCs really get into this co-lending arrangement with banks, which is successful for themselves as well as for the end customer?
So I think it's going to happen exactly the way you said it. The banks want to do it for each, but they want to do it with a very creditworthy partner. The creditworthy partner doesn't have the same need for the funding that the less creditworthy, maybe in terms of rating and size, partners have. So that mix and match will take time, but it's happening, I think, gradually. As Mr. Iyer said, more and more tie-ups have happened. The volumes are still very small, but I think people realize, so it will happen in two categories in my sense. One category that I feel that will get consolidated by banks, and the larger players will be the gold loan because of the capital treatment. It was largely the preserve of NBFCs in the past. But I think going forward, we've already seen PSU banks coming and doing that same business at less than half the rates that Muthoot Finance does or other people do. And so I think there will be co-lending requirement there just to be competitive on pricing. And on some other areas for the banks side, it will be for reach. I believe the EV business is going to be in the next 10 years what the telecom was 20 years ago. And I think it's going to be a huge play, because it's going to be all the way from two-wheelers to commercial fleet over a period of time. So I think there'll be a lot of partnership that will come up. So I think new opportunities is what I'm saying will be one opportunity. Consolidation in certain segments like the gold will give another opportunity because the reach for gold loan customer is with the NBFCs. But the funding power will be, and the desirability of that asset class is on the increase by the big banks, etc. So I think reasons like that will come together. We have seen it in the housing companies now. There is far more support. Also, I think the models, because Mr. Iyer also said it's about process and credit approach, etc. I think models are changing. Earlier, you had to have complete convergence on underwriting standards between the NBFC and the bank. I think now the banks have become a little bit more flexible. They're allowing you to underwrite on some broad guided term sheet kind of tick boxes. And then once you've underwritten the 100%, you can bring it to them and they will approve 60, 70, 80% of that, depending on what matches. So at least it doesn't hold up the transaction. Become more like a refinancing co-lending rather than a co-lending at the same time. So I think some combination of model change, some combination of desirability on both parts and need on both parts will make that happen.
Thanks, Mr. Bindra. I'll for the same question, I'll turn to Mr. Jairam. Since you have worked on both sides, on the banking side and the NBFC side, with the second circular, the change co-origination became co-lending, and RBI allowed direct assignment. And most of the NBFCs want to do a direct assignment, but the bank still says that the seasoning method was much better for me, because at least after 6 months seasoning, I was getting a portfolio securitized. I could see some trend, all of that. Don't you think this entire direct assignment model is equivalent to a DSA, having a DSA? And what should be the right balance? Is it the right method to do or not?
See, the way I think about it, Nitin, is that the market finds its place. Like today, you are caught in an environment where two things are happening. One, overall credit growth in the environment is still low. Right, you're talking about single-digit credit growth of overall credit in the country, right? 9% was the most recent number. If that number instead of 9% were 15%, you would see a very different dynamic in the market, right? Different people. The second piece is the number of NBFCs themselves, right? You talked about there are whatever 8,000-9,000 NBFCs now. At peak, there used to be 13,000 NBFCs, right? So a lot of NBFCs are shut down. Most of them have shut down because of lack of liquidity, right? So fundamentally, you're in an environment where growth is somewhat limited. Liquidity has not been available to the sort of very small NBFCs. What banks want is credit-tested customers, but whom they cannot reach themselves. Right? Banks have their own distribution. Banks want to expand distribution. Right, but they don't want to do it, by taking additional risk. So they want credit-tested customers. So from a bank's perspective, somebody sort of seasoning an account for 6 months, 9 months, 12 months, and then passing it on to them, is the best possible approach. But from an NBFC standpoint, that might be like, hey, I incur all the cost of acquisition, but I don't end up getting as much get to enjoy as much of the results out of it, and I still need to keep some capital. So it doesn't give them as much leverage as they would like. This will settle, but the main thing that's going to help this settle is increase in growth in the market. There should be more business for everybody to do, and when there is, I think a lot of these models will settle down. See, just because co-lending as a model exists doesn't mean that it necessarily needs to succeed, right? There are many models that come up which don't succeed over time, and it's fine, right? The market finds its place. Today, the confluence of needs that needs to happen. On the one side, you need a party that has capital but lacks distribution. On the other side, you need a party which has distribution but lacks capital, right? And those confluence of needs to happen, and the market needs to clear at the right price. Today, you're not seeing that happen. You cannot force it to happen by any means. So if the liquidity goes away even further for from the overall market, you will see more larger NBFCs starting to do this as well, right? Or if the overall credit growth becomes a lot, you might see things go in a different direction. So so the market will find its own way. I don't think we need to necessarily sweat too much about what exactly can we do to make it happen. Like none of us through our sheer will are going to be able to make this market take off, because the market's too big for any party to influence. As of now, as it happens, the business model isn't at a place where the market's clearing, but there are some green shoots which have been there for the last sort of year, 2 years. Maybe some of those green shoots will develop into full-blown trees. Maybe they don't, and either way is fine.
That brings to the end of the session, and thank you very much for a fantastic discussion. I think it was helpful for the audiences and everyone, and I would like to thank you all for taking your time today. Thank you very much.
Thank you, Nitin.
Thank you.
Thank you.